Chapter 11, Accounts Receivable, Notes Receivable, and Revenue. Accounts receivable include not only claims against customers arising from the sales of goods or services, but also a variety of miscellaneous claims such as loans to officers or employees, loans to subsidiaries, claims against various other firms, claims for tax refunds, and advances to suppliers. Trade notes and accounts receivable usually are relatively large in amount and should appear as separate items in the current assets section of the balance sheet at their net realizable value. Notes receivable are written promises to pay certain amounts at future dates. Typically, notes receivable are used for handling transactions of substantial amount. These negotiable documents are widely used. In banks and other financial institutions, notes receivable usually constitute the single most important asset. An installment note or contract may be used in an exchange that grants possession of goods to a purchaser but permits the seller to retain a lien on the goods until final installment under the note has been received. Installment notes are widely used in the sale of industrial machinery, farm equipment, and automobiles. Other transactions that may lead to the acquisition of notes receivable include the disposal of items of plant and equipment, the sale of divisions of a company, the issuance of capital stock, and the making of loans to officers, employees, and affiliated companies. The audit risk for accounts receivable can be high because many incidences of fraud have involved overstatement of receivables and revenue. Revenue recognition may, in some cases, be based on complex accounting rules that are subject to valuation using significant accounting estimates. The determination of the amount of revenue to be recognized for a particular period is integrally related to a number of financial statement accounts, including sales and accounts receivable, adjustments to sales and accounts receivable, service revenue, deferred revenues, and cash. As in all audit programs, the auditor must use the understanding of the client and its environment to consider inherent risk, including fraud risk, and obtain an understanding of internal control over receivables and revenue to assess the risk of material misstatement and design further tests of controls and substantive audit procedures. The substantive procedures for accounts receivable and revenue will be discussed later in the presentation. Because of the risk of intentional misstatement of revenue, the control environment is very important to effective internal control over revenue and receivables. Of particular importance is an effective board of directors and audit committee that provides effective oversight of management's judgments about revenue recognition principles and estimates, as well as an effective internal audit function. Appropriate revenue recognition may involve complex accounting principles, estimates, and computations. As a result, management should make a commitment to competence, especially as it relates to key financial and accounting personnel. Management's commitment to integrity and ethical values, as indicated by its attitude toward financial reporting, are also important in the control of revenue and receivables. With regard to its commitment to attract, develop, and retain competent employees, management should make appropriate background checks of prospective employees and obtain fidelity bonds on employees in positions of trust. Both external factors such as the economy and internal factors such as new products can create new risks for the company and indicate a need to implement new types of controls to prevent the misstatement of revenue. Strong controls over credit sales is an important area of consideration for accounts receivable and revenue. Usually, internal control over credit sales is strengthened by a division of duties so that different departments or individuals are responsible for preparation of the sales order, credit approval, issuance of merchandise from stock, shipment, billing, invoice verification, maintenance of control accounts, maintenance of customers' ledgers, approval of sales returns and allowances, and authorization of write-offs of uncollectible accounts. When this degree of subdivision is feasible, accidental errors are likely to be detected quickly through the comparison of documents and amounts emerging from independent units of the company, and the opportunity for fraud is reduced to a minimum. If management review controls are suitably designed, the auditors may decide to test their operating effectiveness and review any internal audits that have been conducted for accounts receivable and related accounts. The controlling and processing of orders received from customers require carefully designed operating procedures and numerous controls if costly errors are to be avoided. Important initial steps include registering the customer's purchase order, reviewing items and quantities to determine whether the order can be filled within a reasonable time, and preparing a sales order. The storekeeper issues the goods covered by a sales order to the shipping department only after the sales order has been approved by the credit department. When the goods are transmitted by the finished goods storeroom to the shipping department, this group must arrange for space in railroad cars, aircraft, or motor freight carriers. Shipping documents such as bills of lading are created at the time of loading the goods into cars or trucks. The customer is then billed by the preparation and mailing of a sales invoice. Receivables held by companies are collected by receipt of customers' checks and remittance advices through the mail or electronically. All adjustments to sales for allowances, returns, and write-offs of accounts receivable should be supported by serially numbered credit memoranda signed by an officer or responsible employee having no duties relating to cash handling or maintenance of customers' ledgers. This diagram is a flowchart showing the steps in the processing of credit sales from receipt of the customer's purchase order through the shipping of the goods to the customer. As previously stated, a basic characteristic of effective control consists of subdivision of duties. As applied to notes receivable, the principle requires that the custodian of notes receivable not have access to cash or to the general accounting records. The acceptance and renewal of notes should be authorized in writing by a responsible official who does not have custody of the notes. The write-off of defaulted notes should be approved in writing by responsible officials, and effective procedures adopted for subsequent follow-up of such defaulted notes. It is essential for the auditors to have a thorough understanding of the client's business and the industry in which it operates. Regarding revenue and receivables, this understanding includes matters such as the types of products and services sold, the classes and category of the client's customers, whether the business is affected by seasonal or cyclical demand, typical marketing policies for the client and its industry, policies regarding pricing, sales returns, discounts, extension of credit, and normal delivery and payment terms. Compensation arrangements that are based on recorded revenue and typical revenue recognition principles used in the industry and their methods of application. Auditors face a number of potential inherent risks related to receivables and revenue. Most of these risks are derived from business risks that are faced by management. Risk of material misstatement also arise from the possibility of fraud. Improper revenue recognition has been the most common technique used by management to engage in fraudulent financial reporting. If the auditors identify fraud risks related to receivables and revenue, they will make sure they understand the controls established by management to control the risk and that the controls have been implemented. Some of the auditor's responses to risk will have an overall effect on the audit, such as assigning more experienced personnel. Others will include the design of specific audit procedures, such as confirming accounts receivable at year end as opposed to an interim date, or by performing procedures to further address the risk of material misstatement due to management's override of internal control. This chart lists many of the potential misstatements associated with revenue and the associated internal control weaknesses or factors that increase the risk of misstatement. Two common misstatements are the recording of unearned revenue and early recognition of revenue or cutoff problems. Recording fictitious sales without receiving a customer order or shipping the goods and leaving the sales journal open to record next year's sales as having occurred in the current year are examples of fraud in these two areas. These frauds can result when there are insufficient controls, including an ineffective board of directors, audit committee, or internal audit function. The tone at the top is not conducive to ethical conduct, or undue pressure to meet sales targets exist. Other potential misstatements can occur when revenue is recorded when there are significant uncertainties that exist, or when there are significant performance obligations that must still be performed by the seller. Errors can occur in these areas when there are aggressive attitudes by management toward financial reporting. However, the potential for fraud can also exist if there is an intent to deceive by overestimating revenue, by underestimating the effects of the rights of customers to return goods, or by recording franchise revenue when the franchises are sold even when there are significant services still to be rendered. If the auditor wishes to rely on the client's internal controls, they will perform additional tests of controls. One test may include examining significant aspects of a sample of sales transactions, including comparing the customer's purchase order to the sales order and sales invoice for accuracy and for evidence of authorization for credit and shipping. Next, the auditor will compare a sample of shipping documents to related sales invoices to identify that the sales shipped were billed. To test for proper use and authorization of credit memoranda, the auditor will determine that credits for returned merchandise include a requirement that the returned goods be received and examined before credit is granted. If the client has established effective IT application controls for sales transactions, the auditors might decide to test these controls directly instead of testing a sample of sales transactions. When a customer uses accounting principles that require estimates of significant amounts of revenue, the auditor may examine evidence of review and approval of the estimates. These tests of controls will then be used to revise the risk of material misstatement. This chart shows common controls for the accounts receivable and revenue cycle, as well as the typical test for the control and relevant audit objectives or management assertions. Substantive procedures that are performed for receivables and revenue include obtaining an aged trial balance of trade accounts receivable and analysis of other accounts receivable and reconciling it to ledgers, obtaining analysis of notes receivable and related interest, inspecting notes on hand and confirming those with holders, confirming receivables with debtors, reviewing the year-end cutoff of sales transactions, performing analytical procedures for accounts receivable, notes receivable, and revenue, reviewing significant year-end sales contracts for unusual terms, testing the valuation of notes receivable, computation of interest income, interest receivable, and amortization of any discount or premium. Evaluating the propriety of the client's accounting methods for receivables and revenue, evaluating accounting estimates related to revenue recognition, determining the adequacy of the client's allowance for uncollectible accounts, ascertaining whether any receivables have been pledged, investigating any transactions with or receivables from related parties, evaluating the business purpose of significant and unusual sales transactions, and evaluating financial statement presentation and disclosure of receivables and revenue. This chart lists the objectives of major substantive procedures for receivables and revenue and the related primary audit objectives or management assertions. AICPA AU-C 330 and PCAOB 330 indicates that the auditor should confirm accounts receivable unless accounts receivable are immaterial, the use of confirmations would be ineffective, or the auditor's assessment of the risk of material misstatement is low, and the auditors plan to obtain sufficient appropriate audit evidence by performing other substantive procedures. This requirement differs from the international auditing standards that accept confirmation as an audit procedure but do not require the use of confirmation request in any particular situations. This figure shows the confirmation process for accounts receivable. A confirmation request to ABC Company is prepared. The CPA determines that the confirmation request is directed to an appropriate confirming individual and address. The confirmation request is delivered to ABC Company, and ABC Company receives the confirmation request. ABC Company, the confirming party, receives and responds to the confirmation request. The response is delivered to the auditors. The CPA receives the response to the confirmation request. Most confirmations for accounts receivable are still in paper form, although some are now delivered by electronic or other medium. Some CPA firms are now using software bots to automate the entire confirmation process, including requesting the information, following up on non-respondents, and summarizing the results, including sampling results if applicable. There are two methods of confirming receivables by direct communication with the debtor. In each type of communication, the client makes the formal request for confirmation, although the auditors control the entire confirmation process. The use of positive confirmation requests consists of a request addressed to the debtor asking for a reply. Most positive forms ask the debtor to confirm directly to the auditors the accuracy of the dollar amount shown on the confirmation request. Other positive forms, referred to as blank forms, do not state the amount on the request, but ask the debtor company to fill in the balance. The use of negative confirmation requests consists of a communication addressed to the debtor company asking it to advise the auditors only if the balance shown is incorrect. Although positive confirmation requests may be used in any circumstance, the use of solely negative requests should be reserved for situations in which at least one of the following circumstances exist. Either the assessed level of misstatement is low and sufficient appropriate audit evidence has been obtained on operating effectiveness of controls, or a large number of small homogeneous balances are involved, or a low exception rate is expected, or auditors are not aware of any circumstances that would cause the recipients of the request to disregard them. This flow chart shows the steps that are involved in the confirmation process for accounts receivable, beginning with developing the audit objectives and choosing the appropriate confirmation form and timing. Next, the auditor identifies the information and selects the accounts to be confirmed. After the confirmations are prepared and mailed to the customers by the auditors, it is important that the responses be received directly by the auditors. In the case of positive confirmations, the auditors may need to send second requests, and in some cases perform alternative procedures if no response is received. After any exceptions have been resolved, the auditor should thoroughly document the confirmation process in the audit work papers. This slide illustrates the use of data analytics to identify misstatements and potential fraud in the area of accounts receivable and revenue. Although auditing procedures related to revenue and receivables may be performed manually, they may be performed more efficiently and thoroughly using data analytics, where 100% of the transactions or entries in journals and ledgers can be reviewed. Conceptually, an entity should recognize revenue in amounts that reflect the consideration the entity expects to receive for sales of goods or services as performance obligations are satisfied. The FASB recently issued a new revenue recognition standard for accounting for revenue from contracts with customers. FASB ASC 606, which superseded much of the previous industry-specific guidance, establishes a 5-step process for recognizing revenue from contracts with customers. These 5 steps are to identify the contract and the performance obligations, determine the transaction price and allocate the transaction price to the performance obligations, and last, recognize revenue when the performance obligations are satisfied. The auditor should carefully evaluate the propriety of the client's treatment of certain transactions to determine that they meet the criteria for revenue to be recognized. Problems that the auditors might discover include an allowance for sales returns may not be set up for goods shipped to customers with the right to return the goods under certain circumstances. Management or client personnel may have established formally or informally side agreements that significantly alter the terms of sale. Cash receipts from franchise fees may be inappropriately recognized when services have not been rendered to the franchisees. Bill and hold transactions may be recorded when they do not meet the requirements for revenue recognition. Notes receivable may not bear reasonable interest rates at the time they are accepted, resulting in a need to discount the notes to present values. Management might use the percentage of completion method of revenue recognition in inappropriate circumstances or might overestimate the amount of revenue earned. Management of a software company might recognize excessive amounts of revenue on a multiple element agreement that involves providing software and post-contract customer support. The auditors are responsible for evaluating the reasonableness of accounting estimates related to receivables and the recognition of revenue. Examples of these accounting estimates include sales returns, revenue recognized under very complex agreements, and the allowance for uncollectible accounts. In accordance with AICPA AU-C 540 and PCAOB AS 2501, the auditors audit accounting estimates by reviewing and testing management's method of developing the estimates, by developing their own estimates, or by reviewing subsequent transactions and other events that provide evidence about the accuracy of the estimates. The auditors are required to perform a retrospective review of the prior year's significant accounting estimates to determine whether they indicate bias on the part of management. The allowance for uncollectible accounts receivables represents a particularly significant accounting estimate for most organizations. Since the best evidence of the collectability of accounts receivable is payment by the debtors subsequent to the balance sheet date, the approach of analyzing subsequent transactions is an appropriate overall audit approach. The auditor may also decide to independently develop their own estimate of the amount of uncollectible receivables to compare to management's estimate. Compare the details on the aging of accounts receivable to prior year's aging, investigate the credit ratings for delinquent and unusually large accounts, review confirmation exceptions for an indication of amounts in dispute or other clues as to possible uncollectible accounts, summarize in a working paper those accounts whose collectability is doubtful based on the preceding procedures, review with the credit manager the current status of significant doubtful accounts, determining the collection action taken, and the opinion of the credit manager as to ultimate collectability. Compute relationships such as the number of days sales in accounts receivable and the relationship of the valuation allowance to accounts receivable and net credit sales. Transactions between the corporation and its officers, directors, stockholders, or affiliates require particular attention from the auditors because these related party transactions are not the result of arm's length bargaining, by parties of opposing interest. To identify related party transactions, the auditors should review proxy and other filings with the SEC or other regulatory agencies, conflict of interest statements obtained by the company from its management, transactions with customers or suppliers that have unusual terms, and accounting records for unusual balances or transactions, particularly those occurring near year end. This slide shows the auditor's documentation that is needed for the audit of accounts receivables, notes receivable, and revenue, including the work papers for the aging of the accounts receivable and audit of the allowance for doubtful accounts, interest, and notes receivable and revenue, as well as the test of controls and analytical procedures that were performed as part of the risk analysis and the audit program. And this is the end of the presentation for Chapter 11.